Hello, class. We're about to start section 3.5, A Walk on Wall Street. Our learning objectives is to read information from a stock listing, to calculate cost of buying stock and profit or loss from selling, to study the price to earnings ratio and use it to analyze the value of a stock, and to calculate profit from a bond sale. Everyone has the brain power to make money in stocks. Not everyone has the stomach. Peter Lynch. Okay, so now we go down here to number one. It says, as a shareholder in the company, you own part of that company. When the company makes money, it can choose to distribute part of the profit to its shareholders. This money is called a dividend. The stockholder receives a sum of money based on the number of shares of the stock that he or she owns. Sometimes, if a company doesn't make a profit, or its owners or managers decide to reinvest the money into the company, no dividends are paid. So when choosing whether to buy stock in a certain company, one consideration is whether or not that company typically pays a dividend. So number one, if you own a stock in a certain company, why are you entitled to a periodic dividend? Basically, because you are a part owner. That's basically it. Okay, now we go on to the next page. Problem number two. It says describe any advantages or disadvantages of buying stock in a company that pays dividends. The advantage is that you get money up front. The disadvantage is that the company does not have that money in case of an emergency. Besides issuing stock, a company can also issue bonds. Usually, bonds are issued to raise money for the company for startup costs or special projects. A person who purchases a bond is really lending money to the company. The company, in turn, repays the owner of the bond its original value plus interest. As a general rule, bonds are a safer investment than stocks, but stocks have greater growth potential. Describe the difference between stocks and bonds. Stocks, you own a part of the company. With bonds, you loan money to the company with no ownership. Now, stocks can be bought and sold on a stock exchange. The price of a stock, which varies from day to day, even from minute to minute, depends completely on the amount that investors are willing to pay for it. This can be affected by the profitability of the company, the economy, scandals, even global political concerns. Investors buy or sell stock through a stockbroker. Traditionally, this was an individual working for a brokerage firm, but it has become common for people to use online brokers in which the investor initiates the buying and selling of stocks online. In either case, the brokerage usually charges a fee called a commission for the service of having their representatives buy or sell the stock at an exchange. Bonds can also be bought and sold like stock. So, number four, how can an individual buy stock in a company? By purchasing shares through a stockbroker or an online brokerage firm. What are some advantages of investing in the stock market? Possible profit and ownership in a company. Okay, now it says when all is said and done, there are two ways to earn money from stocks: buying a stock that pays a regular dividend and selling shares for more than you paid for them. This means that investors are tremendously interested in the day to day price fluctuation of stocks, as well as indicators of how well the company is doing. A stock table is a listing of key information. Stock tables can be found in newspapers and online financial sites. The stock table shown below, generated on March 1st, 2019, is for a company called the Acme United Corporation, which sounds like the company that makes dynamite and anvils on cartoons. But as near as I can tell, it is not. Let's see if we can make sense of the mysterious mass of numbers. Okay, there's a whole lot of information here. It's going to take some explanation. We suggest that you take notes as you read through the descriptions below, but you might try a quick read through now, then refer back when you get to questions 6 through 11. At the top, we see the name of the company and the ticker symbol, ACU in this case. This is a shorthand symbol assigned by the exchange that represents the stock. The New York Stock Exchange American indicates that this particular stock is traded on the New York Stock Exchange, one of the American stock exchanges. The big bold numbers at the top is the current price of the stock. The current price isn't like the price of milk at the grocery store. It reflects the most recent price at which the stock has been bought from someone trying to sell. This is followed by how much the price has changed during the current day's trading session. If you can add and subtract, this makes the pre-close price redundant. Note that this stock has gone up by a quarter and this session is currently worth $17.40. So of course the closing price on the previous day was $17.15. You wouldn't think there'd be many people buying and selling stocks who can't add, but I guess anything is possible. Open refers to the price at the time today's session began. This is often different from the closing price because many factors can affect what people are willing to pay from day to day. Bid and ask are a snapshot of what people have been bidding to buy the stock and what price current shareholders have been asking for to sell. In this case, $17.32 times 200 indicates that an offer of $17.32 for up to 200 shares has been made. $17.48 times 100 means that someone has offered up 100 shares for sale at $17.48. The 1 year estimated target estimate is what analysts are predicting the stock will price the stock price will be in 1 year. While this is at best an educated guess, it can at least give you some guidance as to whether the stock might be a good buy. Beta refers to the volatility of the stock, which is a measure of how much the price fluctuates. If the beta is close to 1, then the stock stability is similar to the rest of the market. Lower numbers indicate that the price is more stable than average. The earnings date represents the next time the company is expected to release data on how well the company is doing financially. The ranges, days ranges and 52-week range, indicates the highest and lowest price during the current session, as well as the last full year. The latter is particularly useful as it gives you a quick snapshot of how the stock has fluctuated and how its current price compares. Volume describes how many shares have been traded in the current session, while average volume, 3M, provides a 3-month average of shares traded. Lower volume stocks can be more difficult to buy and sell due to availability. Market cap is the total value of the company. It's calculated by multiplying the number of shares that have been issued by the current price. So a little math allows you to calculate how many shares there are. This in turn makes the volume of sales more meaningful. P/E TTM refers to the PE, price to earnings ratio. This is a particularly important number, so we'll study that in detail a bit later. EPS, TTM, represents earnings per share, or the amount of money the company made for each share of stock that has been issued. Clearly, bigger is better. Dividend and yield is the dividend that the company pays for each share, and what percent of the current price that represents. If nothing else, this tells you whether or not the company pays a dividend on shares, but you can also use it for comparison purposes with other stocks. Now, let's put our new knowledge into practice by studying shares of Facebook, also on March 1st, 2019. Okay, now, the first thing this asks with problem number 6 is what is the current price of the stock? So if we look here, the current price would be this 162.28. So we could say the current price is equal to $162.28, and that's per share. What are the shareholders trying to sell it currently asking for? So if you look at the sale price here, now we have the bid is 162.76, the ask is 162.89. So basically, shareholders are asking 162.89 per share. Okay, what do analysts predict the price will be in 1 year? So we look here at the 1-year estimate. Analysts predict the price to be $197.69. Is this stock more or less volatile than the market as a whole? How do you know? So we look here at the beta. The beta is greater than 1, so it is more volatile. What's the highest stock price in the last 52 weeks? So we'll go to the 52-week range. The highest price in 52 weeks was $218.62. Does Facebook pay a dividend to shareholders? No. So number 10 would just be no, because that N/A just means that it's not available or not applicable, so it's no. Okay, now it says use the market cap to find how many shares the company issued. Now, if we go here to the market cap, it's 463.145 billion. So it's 463.145 billion. Now we divide it by the current price, which is 162.28. and that would give us approximately 2.85 billion. And that's how many shares. So it's approximately 2.85 billion shares. Okay, now, as previously mentioned, there are two ways to make money from stocks: buy shares of a stock that pays dividends, or buy stock at a low price and sell it at a higher price. But of course, you can't just go buy stock at the corner store. You need to use a brokerage firm, placing an order that it is then carried out by representatives at the stock exchange. In exchange for that service, the broker charges a commission which varies among brokers. Brokers can also make recommendations concerning that stock to buy and sell, which further justifies their commissions. The amount that an investor receives from the sale of a stock is called the proceeds. The proceeds are equal to the amount of the sale minus the broker's commission. Next, we'll look at some examples of buying and selling stock. Shares of Apple Computer closed at $12.89 on April 1st, 2004. Suppose that an investor bought 600 shares at that price using a broker that charged a 2% commission. Okay, so it says find the amount of the commission that was paid. So we'll take 0.02 times the $12.89 times the 600 shares. When you multiply all of this out, it'll be $154.68. Now 13, it says find the total cost of buying the stock. So you have 154.68 plus the 600 times $12.89. So altogether, this person paid $7,888.68. Now, a stock split occurs when a company increases the number of outstanding shares. Most commonly, this is a 2-for-1 split, in which the number of shares doubles. This can be done for a variety of reasons, but the simplest explanation is that when the price of one share gets particularly high, it tends to scare away smaller investors, and the split effectively halves the price of one share. In any case, the net result is that in an instant, the number of shares owned by shareholders doubles, even though the total value stays the same. Number 14, Apple did a 2-for-1 split on February 8, 2005, then a 7-for-1 split on June 9, 2014. How many shares would our investor have owned after the second split? So if you look at it, it was 2-for-1 and 7-for-1. So that means that it would have went up a total of 14. So we'll take 600 times 14. That would take it to 8,400 shares. Because remember, it doubled and then it went 7 times after that. So that's where we got the 14 times from. Okay, now we go here to back to problem 15. It says our clever friend, the Apple investor, could have sold her shares for 174.97 on March 1st, 2019. If she had done so using a brokerage with a 1.5% commission, what would her profit have been? Remember, profit is the difference between cost and final proceeds from the sale, which would be selling price minus commission. Needless to say, you should show your work. Okay, so this person has 8,400 shares now. And then the new price is 174, or the selling price is 174.97. Now, when you multiply this will give $1,469,748. Okay, now it's a 1% commission on this. So it'd be 0.015 times 1,469,748. So that would be $22,046.22. Okay, so now We would take the amount, which is $1,469,748, and subtract the $22,046.22, and that will give us $1,447,701.78. Now this is the proceeds. This is the final proceeds. Now remember, we're not done yet because remember we have to take off what we actually paid for the stock when we bought it as well to see what our total profit is. And what we bought it for, that was commission, and the price of the stock was $7,888.68. So when we subtract this, we would make $1,439,813.10, and that would be the profit. Now 16, it says, how much money would our investor have saved by using an online trading site with a flat commission of $19.95 per trade? Okay, so the commission on a purchase was 154.68, and then the commission on the sale was $22,046.22. Now we add those together, 154.68 plus the $22,046.22, and then we would subtract off what we would have paid, the 1995, 2 times 1995, and then you would have saved $22,161. That would be a big savings. Now we come to the next part of this exercise. We have the price to earnings ratio for a stock. So it says the price to earnings ratio, commonly known as PE ratio, is a key indicator of how reasonable the current price of a stock is. It compares the selling price of the stock to the annual amount of money the company has earned per share. If the price to earnings ratio for a certain stock is 20, that means that the current selling price is 20 times as high as the earnings per share. This tells us that for every $20 you invest in a company, that company will earn $1. Price to earnings ratio can be a little tricky to interpret. On the one hand, a lower price to earnings ratio indicates that a stock is priced reasonably, as you need to invest less for the company to make a certain amount of profit. But if investors believe in the growth potential of a company, they may be willing to pay a premium for the stock, which would result in a higher price to earnings ratio. To help get some perspective on price to earnings ratio, it's useful to do some calculation. First, a formal definition. Price to earnings ratio is current market price divided by annual earnings per share. Okay, for the Facebook stock table from earlier in the lesson, calculate the price to earnings ratio using the current price and earnings per share compared to the price to earnings ratio listed in the table. Okay, so first of all, we remember the current price was $162.28. Now we have to, well, let me write this. I'm going to put CME for current market price all over AEPS. So that'll be the annual earnings per share. Now we need to go back to the Facebook stock. That was on page 330. And we will look at the EPS, which is the earnings per share, which is 7.57. Now we divide this out. This will give us approximately 21.44. So our price to earnings ratio would be 21.44. So I do this, P/E ratio be approximately 21.44. Now, if we look back here, as the price to earnings ratio is 21.44. So we could say this matches the table, PE ratio. All right, not every stock table you will encounter has quite the wealth of information that the ones at the beginning of this lesson have. A more abbreviated table might have the PE ratio but not earnings per share listed, in which case you could rearrange the preceding formula to calculate earnings per share, which they show here with the solve example 1, which you could read at your leisure. Now on the back, number 2, it says here, based on the result of solved example 1, which do you think was the better investment at that point in time, Facebook or GoDaddy? Okay, now GoDaddy's earning per share was 45 cents, and Facebook earned $7.57 per share. Okay, and let's look at GoDaddy's price to earnings ratio was listed at 166.56. Okay, so we could say GoDaddy PE was high while the earnings per share is low. Which indicates this company is not doing as well as Facebook. Now it says the table below summarizes some basic rules of thumb when it comes to interpret the price of earnings ratio for a stock. Remember that the best approach is to compare a stock's price over earnings ratio to other companies in the same industry, as current market conditions can have a pretty profound effect on price to earnings ratio. Now, if you look here, you can read that at your leisure where it tells you this. Now, if you look here at the price to earnings ratio is greater than 25, the stock might be very overpriced. Okay. Now it says we saw in solved example 1 that the price over earnings ratio for GoDaddy was extremely ridiculously high. Come up with some theories as to why that might have been the case. It could be a lot of reasons. People, I'll just give you one, could be willing to pay more because they believe in the company. Yeah, that's one reason. So there are so many different reasons that I can't go through all of them. Now, we go here to page 335. Now, on page 335, this is a long paragraph here, and I believe that you could read this on your own, but there are a few key things here. It says when an investor buys bonds, the investor is actually loaning money to the company or government entity that issues the bonds. In exchange for lending that money, the investor will receive a fixed return on his or her investment for a given period of time. The ending value of the bond is called the face value. This is typically $1,000 but can vary. Bonds also have a maturity date, which is the date that the face value is returned to the investor as well as interest. In some cases, no interest is paid until the maturity date, at which time the full amount of interest is paid. Coupon bonds, on the other hand, pay an annual or semi annual interest payment known as a coupon. Okay, you can think of it this way. If someone offers to sell you a $20 bill for $15, that's a pretty darn good deal. But the catch is that you don't get the $20 until some predetermined time later down the road. That's what a bond is. It's actually pretty simple. But here's where it can get more interesting. Suppose that you get tired of waiting for the time when you get the $20 bill and you sell the bond to your neighbor for $18. You've made $3 on the investment and you're done. Your neighbor now waits until the maturity date, cashes in the bond, and makes the other $2 of the original $5 in profit. This is how bonds are bought and sold on the open market. Of course, your neighbor would pay more than $20 for a bond with a maturity value of $20. But if you are desperate for cash, you might be compelled to unload the bond for less than the $15 you originally paid. You've taken a loss, but at least you got some money out at the time you needed it. All right. Now, this is important. Investors buy bonds for two main reasons. First, they're much safer investments than stocks, even though they have much less opportunity for a big profit. The interest is guaranteed as long as the company that issued the bond stays in business and has the money to pay its debts. This makes bonds a safe but not guaranteed investment. Second, bonds are used to offset losses on stocks when the economy is in a down cycle because the value of bonds tend to go up when the value of stock goes down. Here's a short version of why that makes sense. In our earlier hypothetical example, where they're making a $5 profit for waiting to cash in your bond, if the economy is booming in the meantime, prices in general will tend to go up. So the $5 you're getting at some point in the future has less buying power than the $5 you were expecting when you made the investment. This makes the bond in effect worth less. The opposite is also true. If the economy fizzles after you buy that bond, the $5 you eventually get will in effect be worth more than the $5 you thought you were getting. So the bond is worth more. Stocks tend to rise when the economy is doing well and fall when it's not. So the value of bonds usually goes in the opposite direction of the stock market. Okay, so we're going to look here on the back. Oh, we got to look at the solved example. It says, suppose that you buy a bond with a face value of $1,000 that was originally issued 18 months ago. The maturity date is 4 years from the time it was issued, and the interest rate is 4% simple interest per year. If you pay $820 for the bond and keep it until the maturity date, what is your profit? First, we'll need to calculate the amount of interest the bond earns so that you can find your proceeds from the bond. We're told that the interest is simple and is 4% per year. So we use our simple interest formula and we'll get here $160 in interest. With the face value of 1,000 and 160 in interest, the bond will be worth $1,160 at the maturity date. So the profit is 1,160 minus 820, which will give you $340. What percentage of your original investment is the profit that we found in solved example 2? Okay, so we have here, we have $340 in interest, and we'll divide that with what was paid for the bond, which is $820. So it's approximately 41.5% interest. Now, if you divide your total percent return from question 4 by the amount of time in years that you hold the bond, you'll get your percent return per year or annual return, which is a key indicator of how well an investment performs. A long-standing rule of thumb on long-term investments in the stock market is that you can expect annual returns in the 6 to 7% range. How would this bond investment compare? So you have 41.5%, and you'll divide that by 2.5 years. And that will give you approximately 16.6% per year. So, by comparison, this is a very good investment. Okay, now, and we are done with section 3.5. Now we're going to move on over to section 3.6. We have a taxing situation. It says, understand why we pay taxes. That's our learning objective. And then explain the basic process of paying taxes. Okay, so now what we need to do in 3.6, and also to determine the amount of tax due based on taxable income. In this world, nothing can be said to be certain except death and taxes. That's Benjamin Franklin. If you earn a paycheck through a process called withholding, taxes are automatically taken from the amount you've earned. The amount of tax that is withheld is based on two main factors: how much you earn and paperwork you fill out through your employer describing how many other people depend on you financially. The intent is to estimate the amount of tax that you will owe at the end of the year and pay some of it during each pay period so you don't end up with a big bill that you can't afford to pay at the end of the year. When it's time to file a tax return, you'll find out if you paid too much, which entitles you to a refund, or too little, which means you need to pay more. Our tax system is designed so that people who make more money pay a higher percentage of their income in taxes than do those who make less money. The range in which your income falls is known as a tax bracket, and the bracket you're in will determine how much of your income you will owe. It's essentially impossible to understand taxes without understanding tax brackets. So that's where we'll begin. There are four different filing statuses. We have single, which is self-explanatory; married filing jointly, which is when a married couple files a single return for both; married filing separately, which is when married individuals decide to file separate returns; and head of household, which is for unmarried individuals who financially support others. There are different income levels that qualify you for certain brackets depending on which filing status applies to you. The following is a table of tax brackets. Now, for each filing status, the range of incomes listed in the column determines which tax bracket an individual falls into. For example, notice that in the second row of the married filing separately column, the range is $9,526 to $38,700. And that row has 12% in the tax rate column. This tells us that a married taxpayer filing separately with taxable income between $9,526 and $38,700 is in the 12% tax bracket. In a while, we'll study exactly what that tells us about the amount of tax he or she would pay. Number one, if a person filing as single has taxable income 42,000, what tax bracket is she in? So we go to single, 42,000 would be the 22% tax bracket. What about a married couple filing jointly? So 42,000 filing jointly. Let me see, I'll put single here. So 42,000 filing jointly would be 12% tax bracket. And I will put married filing jointly. Now for the big question. How much would that single person pay in taxes? If you said 22% of 42,000, that's a fine guess, an incorrect one, mind you, but a fine guess nonetheless. So what's the deal? What does the 22% tax bracket mean? In short, all taxpayers who are single pay 10% on the first $9,525 in taxable income. They then pay 12% on the next $29,175, which is the amount that falls into the range $9,526 to $38,700. Finally, they pay 22% of the amount left over, $38,700. So even though a lot of people think that being in the 22% bracket means they're paying 22% of their income in taxes, that's just not true. They're only paying 22% on the amount over $38,700. The majority of their income is probably being taxed at a much lower rate. Let's have a look at how we can use the tax bracket to calculate the amount of tax someone would owe. Okay, using the information just provided, calculate the amount of tax that our single person would pay on income of 42,000. We need to look at the information in the tax bracket line by line and break our calculation into distinct pieces. First, our taxpayer would pay 10% of the first $9,525, which is shown here. Next, look at the 12% row. Since her income is more than $38,700 boundary for that bracket, she has to pay 12% on the full amount that falls in that range. We find this by subtracting the upper boundary of that bracket, 38,700, minus the upper boundary of the previous bracket, which is $9,525, and we multiply by the 12%. Okay, now we're in the 22% row. So we need to find 22% of the part of her income that's above 38,700. This would be the difference between her 42,000 income and 38,700. So we get 22% of this value here at the subtraction will give us $726. Finally, we add up the amounts we've calculated. So these are the amounts. Her total tax owed is $5,179.50. How much would the taxpayer in the solved example have overpaid if she had misunderstood what the 22% tax bracket means and simply paid 22% of her income in federal tax? So if we took 22% of $42,000, so it'd be 0.22 times 42,000, and that's equal to $9,240. So we'll take our $9,240 and subtract this $5,179.50. So that would be $4,060.50. So she overpaid, or I should have said she would have overpaid. Yeah, let me change that to would have overpaid. She would have overpaid $4,060.50. That's quite a bit of money to overpay. Oh no. Now we go over here to the next page. It says here, since many Americans are, shall we say, somewhat math challenged, the Internal Revenue Service, IRS, the government agency responsible for collecting taxes, publishes tables that let filers look up the amount of tax that they should pay. Their documentation even includes an example with the instructions. In this case, for Form 1040, which we'll study in a bit, it says example, Mr. and Mrs. Brown are filing a joint return. Their taxable income on Form 1040, line 10, is $25,300. First, they find the 25,300 the 25,350 taxable income line. Next, they find the column for married filing jointly and read down the column. The amount shown where the taxable income line and filing status column meet is $2,658. This is the tax amount they should enter in the entry space on Form 1040, line 11A. Now, number 3, it says use the tax bracket info from earlier in the lesson to calculate the correct tax amount for Mr. and Mrs. Brown. Then compare to the result in the 2018 tax table. If the Browns believe the table without doing any calculation, will they pay too much, too little, by how much? Okay. So according to this, the Browns will pay $2,658. That's according to the table. Now we have to do some calculation to see whether or not this table is accurate. So we know for married filing jointly, the first 10% is taking out the $19,050 based upon the tax table. And then the next 12% is taken out of the $25,300. That'll be minus $19,050. Now, when you calculate all of this, your answer would be $2,655. So the amount shown on the table is $2,658, and the calculated amount is $2,655. So the Browns will pay $3 too much. What would happen to you if you fail to pay your taxes? Discuss, and if you're able, maybe do a little bit of internet research. Basically, you can have your check garnished. You could be jailed, check garnished, jailed, audited. I think 3 examples is good. Okay, next page. It says, where do your tax dollars go? While paying taxes really hurts, it can help at least some to know exactly what those dollars are accomplishing. There are a handful of websites that illustrate where federal tax dollars go. And for people who stink at percents, which of course does not include you, or some sites you can just enter a taxable income and see how that money is divided up. But we don't need that. We'll just use the percent. The information in the chart is from 2017. Now, we have our graph here. Now we move on to the next page. And actually, as far as I know, this will be our last page in section 3.6, or the last page for this chapter, I should say. So now it says if you paid $6,500 in federal taxes in 2017, how much of your money went to education? So if you have $6,500, and it says how much went to education. So if we go back, education is 3.99%. So yeah, 6,500 times 0.0399. Now when you multiply this out, it'll be approximately $259.35. Now 6, for every $100,000 in total income and in income tax revenue collected by the IRS in 2017, how much went just to pay interest on the national debt? Let's see. Interest on debt is 14.20. So yeah, 6,500 times, so it's at 14.20%. So it's times 0.1420. So we would take that. Oh, it says 100,000. Oh, you know what? Okay, I made a mistake here. I need to go down here to number 6. So it's supposed to be 100,000 times the 0.1420. And when we multiply that, we would get $14,200 in taxes. And that is it from section 3.6.